afternoon, everyone. Welcome to our seminar, and thank you for joining. This is Pamela Michaels with Asset Preservation, and our presentation today is a pretty fast-paced 45 minutes on advanced 1031 concepts, specifically parking structures. And because of where we are today, we are also going to have a section on the 1031 deadline extensions resulting from the coronavirus. That will appear at the end. I will probably make mention of it as I proceed this morning or this afternoon through the presentation. So those of you that know me know that I'm a senior vice president with Asset Preservation, a nationwide qualified intermediary. I have been with the company for more than 15 years, and I teach too often to even mention. It's probably once a week, and now I have converted my presentations to webinar format because of the times. So asset preservation is a 25-year-old plus qualified intermediary, and we do all types of exchanges. And that is why today's presentation is on the more complex structures. So this is an advanced presentation. Would like to hear a different presentation or have me present to them in-house, I'm more than happy to arrange that. Today, we will not be taking Q&A through the presentation because of the short time period. But anyone that has questions can call or email me after the presentation. I will be emailing the handout to everyone. And at the end, you will see my direct contact information, both my email and my phone. So outline-wise, today we're going to be talking about safe harbor parking arrangements. So those are parking arrangements that the code provides for. There's a specific structure set forth in the code that we follow as a qualified intermediary. And when we follow those requirements, our client is engaged in what is called a safe harbor exchange and therefore has certainty that their 1031 will qualify. We are going to talk about the parking arrangements that are included within the safe harbor, reverse exchange structures and options. We're going to talk specifically about how you meet the exchange equation in a reverse exchange and what is required. Then we're going to talk about improvement exchanges, which is the second parking arrangement given a safe harbor in the code. And very importantly, particularly for attorneys, parking arrangement documentation. It's confusing. What are the documents going to say in this parking arrangement? What should I expect to see? Special considerations. We're going to talk about transfer taxes in a reverse exchange. And we're going to talk about a tool that allows certain exchangers with certain facts to actually get 360 days to perform a 1031 exchange. And we are going to summarize this all with what you need to do if you want to perform a reverse exchange. And then finally, as I mentioned, we're going to talk about the Notice 2020-23 1031 timeline extensions. All right, so first of all, what is a reverse exchange? And let me say what it's not. So in a regular forward exchange, we sell or relinquish property and close, and then we buy and close on our replacement property. So a reverse exchange is where we are closing on the replacement property before we have closed on the sale. So there's a distinction. You can be under contract to buy replacement property before you've closed on the sale. That does not convert your exchange to a reverse exchange. You get converted to a reverse exchange when you actually close on the replacement property first. Now, If you're in a situation where you've located your replacement, but you haven't closed on your relinquished, and maybe don't even have a contract for sale on the relinquished, I don't recommend you immediately go and begin a reverse exchange because it's complicated and costly, as you are about to hear. I would do everything in your power to structure your exchange as a forward exchange or a delayed exchange where you sell first. Now, that said, I have many corporate clients, corporate large portfolio owners that always do reverse exchanges. And that is because they want certainty that they have locked up their replacement property and closed. And they have a large portfolio and are able to pick and choose what they may be able to sell as the relinquished property. What is an improvement exchange? I often get questions from clients wanting to know if I can take my 1031 equity and use it to build or make improvements to the replacement property. The answer is no, not unless we structure your exchange as an improvement exchange. So I have an example coming up where it's an $8 million sale, and let's just use that. And let's say it's all cash, 8 million, and you're buying a $6 million property. What about that 2 million? Well, if we set this up as an improvement exchange, that 2 million could possibly be used for improvements to the replacement property. But as you are going to see and hear, there are very strict restrictions on doing an improvement exchange. It is not for the faint of heart. Um, we also do reverse and improvement exchanges at one time, where we purchase the replacement property and you, the client, also does improvements before the sale of the relinquished property. And we'll talk a little bit about that structure as well. Now, I will say to you, with any of these parking arrangements, it is critical to plan as far in advance as possible. These are not structures that you can call me the minute I get off this webinar and say to me, Pamela, I have a closing tomorrow. I want to set it up as a reverse exchange. Whereas you could call me when we get off the webinar and tell me I have a closing tomorrow and I want to set it up as a forward exchange. Okay, but reverse exchanges are very different in nature from um, regular exchanges. All right, so here's the revenue procedure that provides the safe harbor for your reverse exchange. Revenue procedure 2000-37. Now you may structure outside the safe harbor, and as you're going to see, the safe harbor has limitations. We, as a qualified intermediary, typically do not do reverse exchanges outside the safe harbor because there is no certainty as to whether they're going to qualify. And when they are done outside the safe harbor, uh, the the tax attorney or advisors involved will look to case law to see to what as to what may qualify. Now there are exceptions to every rule, but generally we do not do outside the safe harbor exchanges, reverse exchanges. All right, so let's talk about a little bit about what goes on with a reverse exchange. What are the first couple steps you need to take? Well, we are going to first talk about what property is parked. In every reverse exchange, the exchanger has to decide whether they are parking the relinquished or the replacement property. One or the other must be parked. What does parked mean? It means the qualified intermediary sets up what's known as an exchange accommodation title holder, EAT. We form an LLC which we own during the parking arrangement. And that EAT acts as a straw man. And that EAT will take title to either what's being sold or what's being purchased on behalf of the exchanger and hold title in that format for the duration of the exchange. So the revenue procedure requires one or the other to be parked. So it's a big decision what we park, and we go through a couple different factors to determine which is the best property to park. I'm going to illustrate some of those factors, and then I'm going to go into some diagrams. So uh, where the properties are located is important because it can control transfer taxes due, and we're going to see why in a second. In addition, other factors are what kind of property are we talking about parking? If it's got environmental issues, that may be more difficult for us to park than a residential development. So the positives of parking replacement property are the exchange equity does not need to be present. What does that mean? Well, I'm going to stick to one example for this 45 minutes, and it's my $8 million sale. I'm going to give you a few more facts that we're going to come back to. But on that $8 million sale, I'm going to say we have $6 million of equity and $2 million of mortgage debt. So in performing any exchange, even a forward exchange, if we want full deferral, we basically need to buy one or more properties worth $8 million. And we need to make sure on the day that the tax owner takes title to the property, they have $6 million of equity in the deal because that's the equity they have on their sale and that needs to be reinvested. When we park replacement property, we do not need to have that 6 million in on day one because on day one, the replacement property is owned by the EAT. And so we can have more leverage on day one than we ultimately end up with when the property is transferred to the exchanger. In addition, when we park replacement property, it allows for multiple relinquished properties. What does this mean? Well, maybe you haven't decided what you want to sell as your relinquish, or maybe you want to sell multiple relinquished properties. Maybe you're buying a $40 million replacement property and you want to sell 4 for 10 million. So when we park the replacement property, it allows for multiple relinquished properties. Negatives. The lender may have issues lending to an exchange accommodation title holder. So if you're not buying your replacement property for all cash and you've got a lender coming in, you are not the borrower. The exchanger is not the borrower. The exchange accommodation title holder is. So the lender has to underwrite the loan very differently than a typical loan to a borrower. If there's a prepayment penalty, that's going to also cause a problem. So you never want to do a reverse exchange with a lender where the loan documents provide for a prepayment penalty because it's likely that we're going to have to pay that loan down before we transfer the replacement property to the exchanger in order to meet the exchange equation. And we will pay it down with what? Equity that comes in from the sale when the relinquished property is sold. In addition, with API, the mortgage and note that the lender requires be signed, although it will be signed by the EAT, and we pretty much sign any mortgage and note the lender requires, it has to be non-recourse to the EAT, although the exchanger can guarantee. So those are some of the issues that come up with parking replacement property. Now I'm going to have a slide that's complicated, so bear with me. This is what it looks like to park replacement property in a reverse exchange. In my example, I have an $8 million sale. So I am going to be funding somehow to the exchange accommodation title holder $8 million of sale proceeds, of total value, because the exchange accommodation title holder is going to use this money to buy replacement property. But I don't have my $6 million of cash sitting around because I have not, at this point, sold my relinquished property. I only have 2 million of cash. So I'm going to loan the exchange accommodation title holder 2 million of exchanger money, and I'm going to get $6 million from a lender to buy my replacement property. Closing occurs, and the exchange accommodation title holder is now holding title to the replacement property. Note, while we hold title to the replacement property, the property is net leased to the tax owner. So even though the EAT is on title, from the world looking in, the tax owner has ownership, control under this net lease, and all rights and obligations with respect to the property, notwithstanding the fact that we are on title. Now we hope, and notice at the bottom, we have maximum
I
in a
let her
safe
come in
harbor
as a
exchange,
host.
180
I didn't
calendar
realize
days
that.
to
So
complete
I
the
had total
exchange.
control,
So we're
and she
purchasing the
had total
replacement
control.
property for $8 million
And then I just
and
muted
parking it.
myself.
We now have
But
a
I came in
maximum
as
amount
API, so it
of
doesn't look weird. It's
invalidation
not my
when we
name.
park the replacement
Yeah.
property to sell the relinquished property. So here we go. We've sold our relinquished property. We did it within the 180 days. What happens? The money comes into the EAT from the sale. So
30
on the sale,
minutes?
remember we had $8
Not
million from the
people.
sale. We
No,
had
not this one. This is
$6 million
27
of
people.
debt, $2 million, I'm sorry, $6 million
No,
of
that one's in
equity,
2
$2
hours.
million of debt. $2
In
million
2 hours, I'll
was
have to be
paid off
on
to the
that,
lender, $6 million
getting that
comes to the
started.
EAT. What
And
does
when
the
I
EAT
tell
do
Scott
with
to
that
log in
$6
as a
million?
host, he's going to be all
Well, the
flustered.
first thing
Watch.
we're going to do is
Wait,
pay down the
wait,
loan
how do I do it?
because
Do that, and
we
where do I
don't
go? And
want
I don't know. We didn't do this yesterday.
$6 million
Sorry, freak
of
out.
debt on the replacement
Oh,
property. We want the
really, trust
exchange
me.
equation to be fulfilled. So we're going to pay down the debt, and then the balance of the 4
You know what? I'm
million
going to
we're
get
going
him
to
on
give
the
back to the
phone,
client,
and I'm
the
going to walk
exchanger,
him through what
because
to
in
do. That's
fact they lent us the money to perform that
good.
exchange.
All right.
So prior to transferring
We're going
title to the
to do
replacement property
this.
to the exchanger, we are going to pay down the
I wish I
loan
could control his
proceeds
computer.
by $2 million. So at the end of the day, we have met our exchange equation. And excuse me, I had given you 6 million, but it's 4 million of debt that we had on the relinquished property and 4 million of equity. So we purchased for 6 million. We pay down by 2 million our replacement property debt. And now we have 4 million of debt on our replacement property and 4 million of equity. And that allows us to get full deferral of our 1031 exchange because we have the right amount of equity and the right amount of debt into the replacement property at the end of the exchange. And let me go back a second to this slide because that's when we transfer the replacement property to the taxpayer. Once the loan is paid down so that there is 4 million of equity and 4 million of debt, which is what we needed to meet our exchange equation, then we transfer the property to the exchanger and they have met their exchange equation and the reverse exchange is over. If we were trying to park the relinquished property, the loan on the replacement property is much easier. Why? Because the EAT is not involved with the lender. We park the replacement property, we park the relinquished property. So as far as the lender is concerned, if there is someone financing the replacement property, the exchanger is taking immediate and direct title to the replacement property on day one. The relinquished property is getting transferred to the exchange accommodation title holder. So we don't have to worry about lender issues on financing, but we have to worry about some other factors. On day one, the equity and debt should match at the beginning to avoid boot. So if we were selling for 8 million and I had 4 million of equity and 4 million of debt, on day one, when I acquire the replacement property, we need to have 4 million of equity and 4 million of debt on the property. So also on the relinquished property, there may be a due on sale clause, which could be triggered by the fact that the relinquished property is transferred to the EAT. So you have to look at those issues in advance. Okay. Next slide is going to give you a depiction of what it looks like to park the relinquished property. Here we go. The relinquished property is parked with the EAT. We lease the property back to the taxpayer on day one. The taxpayer then loans us the funds, and you could get it from a lender as well, to buy the replacement property, and the replacement property is deeded directly from the seller to the taxpayer. Now remember, we're still holding the relinquished property. Within 180 calendar days, we need to sell that relinquished property to a buyer. If that's not accomplished in that time period, we're going to be transferring the relinquished property back to the exchanger, and the exchanger would be the proud owner of two properties. Okay. So notice in this case that um, because we are parking the relinquished property, we cannot make decisions after the fact about what property is going to be relinquished. You decide that on day one. So you don't have choices, although we can park multiple relinquished properties if owned by the taxpayer. It does add a degree of complication to the exchange. Um, Okay, so the end of the exchange, of course, once we sell, we're going to be funding the monies that came in from the exchange back to the taxpayer to replace the money that they loaned to the EAT for purposes of acquiring the replacement property. Okay, now for the time being, I'm going to switch gears to improvement exchanges. I'm going to come back to reverse exchange timelines when I get to the notice 2020-23. But one final note I want to make here is in reverse exchanges, you still have only 180 days to complete the exchange. From the day the property is parked with the intermediary, if you're parking replacement property, you have 45 calendar days to identify relinquished property. And these deadlines, if you're doing a reverse exchange right now, may be altered by the notice I'm going to talk about at the end, because the extensions also affect and apply to reverse exchanges. All right, so why perform an improvement exchange? I mentioned in the beginning, it may be you're buying property you want to improve. You might want to build something from the ground up, or you might want to refurbish. Now, one suggestion is that instead of complicating your world and doing an improvement exchange, you simply identify and acquire additional replacement property to absorb the value you need to spend and get a construction loan. And that may be the best option for many investors once they understand the total requirements. So first of all, with an improvement exchange, you have to identify not only the replacement property, but provide as much detail regarding construction of the improvements as is practicable at the time identification is made. So this means you've got to give us not only that you're buying 133 Broadway, but that you're planning on constructing a 40,000 square foot building there and some basic information about the nature of the improvements. That would be in your identification, and that would also be the way we describe the replacement property in the exchange documents. So it's critical to the validity of the exchange that those improvements are also described. So here's how it looks to perform an improvement exchange. Taxpayers is going to sell relinquished property to a buyer. And by the way, this can happen simultaneous with the acquisition of replacement property. You can sell and then purchase from the replacement property, or you could actually purchase replacement property first. And while we're parking and improving that replacement property, sell the relinquished property to a buyer. That last description is a reverse improvement exchange. So in this diagram, we sell first, money comes into the EAT, and we fund the purchase. The replacement property goes to the EAT. The 180 days has begun when we park that. That is the maximum period of time the safe harbor allows an investor to have to make improvements to the real property that constitute real property under state law. You cannot prepay contractors. If there are bricks you bought made of gold sitting on the property, that's personal property, not real property, that amount will not count. However, hard and soft costs do count. So permits, architectural fees, things of that nature, you can use 1031 equity for. All right, so we're going to give you a construction agreement, and that's going to allow you to do the construction on the property. And then finally, once you're done, the EAT is going to deed the replacement property to the taxpayer. Hopefully that occurs within the 180 days. Here's a diagram of how it might look. You're going to have a sales price of about 5 million. You had costs of sale, which we are allowed to pay out of the 5 million because they're exchange expenses without creating tax liability. And we had net equity of 4.7. We had no debt. We spent 3 million on the lot purchase, 1.2 million on site work, 500,000 on foundation with a total value of 4.7. Now note, I use this example because it clarifies something. It clarifies you don't have to be CO'd. What you're trying to accomplish doesn't have to be built. You just have to have created real property and spent money on real property. And it could take you another 4 years to get the note or the building built. And that does not affect your exchange. You just have to spend your value in the 180. Okay, here's some of the documentation. So we're going to have our regular exchange documents with a reverse exchange, and in addition, parking arrangement documents. We're going to have a QEAA, Qualified Exchange Accommodation Agreement, which outlines that we're parking your property. We're your straw man. You want some evidence that we don't own it free and clear of your rights. There's going to be a lease where we lease the property back to the exchanger. A net lease, they have all rights and obligations. You want to control it. There's going to be a construction management agreement between us if this is an improvement exchange. We're going to have an assignment of the replacement property contract to the QI, not the EATS. And there's going to be a notice of assignment of replacement property contract. Those are standard documents in an exchange. Closing instructions. Okay. Then there's going to be a note if we're getting a loan. There's going to be a loan to finance the replacement property, and we're parking replacement property. There can be a note, and the lender may require the EAT to sign a mortgage. So that may be part of the package as well. We do not prepare the note and mortgage, the lender does. Okay, so it's just given to us. Special considerations. If we are parking property, we are going to want it, and it's not usually residential will waive, but commercial property, we're going to want a clean environmental report. If there was a problem, we want to see it's cleaned up. If there's a problem and it still exists, we'll take a look at it and may waive it, but we do require an environmental report to park property. Require casualty and liability insurance. We're on title. We don't want to end up in a lawsuit. Very importantly, the EAT we form is an LLC. The client, when we are parking replacement property, will tell us what they want the LLC to be called and where they want us to form it. And the reason is because when we're done with the reverse exchange, when we're parking replacement property, we are going to transfer the replacement property to the exchanger by assignment of membership interest in the EAT, not by deed. So at the end of the day, the client ends up owning the EAT. And one of the questions we're going to ask you in the very beginning is, do you want this EAT member or manager managed? You're going to want it manager managed in 99% of the cases, because otherwise API is going to be managing your LLC, and you don't want to have to come to us every time you need a document signed. So you're going to tell us who you want the manager to be of the LLC. That manager will have authority to carry out all operations with respect to the property. There'll be net lease terms. It's a triple net lease. You don't want us having any obligations. The client's going to pay all expenses, has all obligations. Interesting, we do file a tax return for the period of the EAT's ownership, but all of the income and expense, because the net lease will be reported by the exchanger on its tax return under the net lease. Now, depreciation cannot be taken. That's the only tax expense that the exchanger cannot take during the term of the parking arrangement. I've already addressed formation of the EATs. I've already addressed transfer of parked property by deed or assignments. Again, generally speaking, we transfer by assignment of membership interest, and unless there is another reason to transfer by deed, it's generally much more work and more complex to transfer by deed, whereas assignment of membership interest is a piece of paper. Next, we're going to get to consideration for the transfer of the parked property. So transfer taxes. Whenever we have a parking arrangement, we have an additional transfer. Either we're transferring property, the relinquished property is getting transferred first to the EATs and then to the buyer, or we're parking the replacement property, in which case the replacement property is getting transferred from the seller to the EAT and then to the exchanger. So there's an additional transfer. So one of the issues that always comes up when we're trying to decide which property to park is, what about transfer taxes? So that's why I mentioned to you that we have to look at the jurisdiction. I want to know where the properties are that we are possibly buying and selling. And I want to know, in addition, um, what they are, commercial, residential, and so forth. And then we'll look at exemptions. So we're fortunate in New York, not so fortunate in New Jersey, that we have an exemption on the state and local level from double transfer tax when we are parking property in a reverse exchange because it's considered a straw man transaction. There is a old New York City case where it says conduit transactions are not taxable, subject to transfer tax. And then this New York advisory opinion that came out a lot more recently, because we had the issue until 2016, indicates that again, straw man reverse exchanges are not subject to double transfer tax. So we had that relief in New York. However, if one property is in New York and one is in New Jersey, or all my properties are in New Jersey doesn't have an exemption. So you're likely going to be subject to double transfer tax if we have to park a New Jersey property, and that is a cost consideration, obviously. Some states, particularly the southern states, have an agency exemption. The IRS has approved inclusion of language in the QEAA that specifies that the EAT is acting as the exchanger's agent for all purposes other than for federal income tax purposes. So in some of the southern states, we'll include at the client's request agency language, and that can provide the exemption from double transfer tax. You got to be careful because sometimes being your agent under state law will disqualify the exchange under state law, and state law will not allow the deferral. So there's just a lot of issues that have to be examined in a reverse exchange to ensure we're setting this up right. And these are the kinds of things I'm going to talk to you about on day one. You call, you tell me what you're buying, what you're selling, what you think you're buying, what you think you're selling, and we're going to walk through which is the best property to park, what are transfer tax possible issues, environmental issues, other related cost issues, and even title insurance can come up when we're parking replacement property because we have to know when are we getting title insurance, and can you get an endorsement? If we're parking replacement property, can we get an endorsement so the title insurance continues once the property is transferred to the exchanger? Or are we not at all concerned about that because we have gotten an opinion that the title insurance will continue to be enforceable in spite of the transfer of 100% of the membership interests of the EAT. So those are the kinds of things we look at. Um, sorry, I'm trying to change my page here and it's a little frozen. Just a second here. Go. Okay, if we have a transfer tax exemption, when is it taxed? If we're parking the relinquished property, no transfer tax when the property is conveyed to the EAT, but tax is paid based upon the sale price when the property is transferred from the EAT to the buyer. If we're parking the replacement property, again, if the exemption applies, transfer taxes are paid when the property is acquired by the EAT, but no transfer tax is due when the property is conveyed to the exchanger. So that's generally the way it would work. And now let's shift gears one more time and go to how we get 360 days to exchange. So it's got to be a specific fact pattern. And that fact pattern would be as follows. Example, let's say we're going to buy property and we are closing first on our replacement property. And it's a $30 million purchase. Um, but our sale, and I want to get the example right, sorry. Our sale is, let's write 30 million purchase. Now I'm going to switch the facts. So we have a $15 million purchase and a $30 million sale. And we're going to close first because we want to or have to, doesn't matter why, on the $15 million replacement property. So we close first on the $15 million replacement property. And now, from the date we park that replacement property, we have 180 days to sell a relinquished property for $30 million. So we proceed to sell our relinquished property for $30 million. And let's take an example. Let's say we're closing on January 1st on our on our replacement property. So we basically have 180 days from January 1st to sell our relinquished. Let's say we run very close to that. We get maybe May 15th. We sell our relinquished property on May 15th. We are done with our reverse exchange as to 30 million because we parked replacement property for 30 million. We've now sold our relinquished property for 30 million, and $15 million of the exchange is complete. Now, from May 15th, we have another 180 to perform a forward exchange because we just sold our relinquished property and spend the balance of the $15 million in a forward exchange. So this allows you to get, hypothetically, 360 days to complete your exchange if you were right up against the last day. And obviously this can only be used where you are first buying replacement property, which is parked and is less in value than your relinquished property. Okay. What do we need to do to set up a reverse exchange? Well, what we do is I ask a lot of questions and then I get some documentation in, and the first thing we do is prepare an engagement letter for the client to approve, as far which will contain the structure of the exchange and allow the client to say, yes, this is the way I want to perform, this is the right structure. So the first thing we're going to do is determine whether to park relinquished or replacement property. We're going to consider the values,
Oh, my coffee's
the
here.
location,
Oh, yeah, that's
mortgage
fine.
terms and debt, both of what's being sold and what's being purchased, environmental issues, transfer taxes, and title insurance.
She's
We're
cute.
going to determine who is the tax owner. Who is the tax owner of the replacement and relinquish? Well, they must match. So note this. That's one question I'm going to ask you. You're going to tell me, I want to buy this. We're going to say, well, who's buying it?
That's so
And
cute.
if it's an entity, is that same
Um,
entity, is the tax owner also going to sell relinquished property?
um,
Sometimes with my REIT clients, we'll have parking of replacement property
Joshua,
by multiple tax owners because we don't know
did
which
you see
of
the
their
two emails I
related
sent you? The one
entities is
from
going to be able to
Natalia's?
sell
Okay.
within the
One from
180
Janice.
days.
So
So
I
we
just wanted
might
you to read
establish
each one to each of
multiple
them so you
parking
know what their
arrangements
expectations
if
are.
there are multiple
Also,
tax
Gianna has
owners.
a
You're going to
Zoom
need to
call with her
form the
team
each. I'm
today,
going
and
to
I don't
need
know
to
if
know
she's
where
been
you want us to
submitting things
form it.
to
What do
Amy.
you want us to call it? Again,
I
that
briefly scanned
applies where
Amy's
we're
email, but
parking the
haven't looked in
replacement
super
property.
close
And then
detail, so
we've
I
got to
don't know
get
what
the
she's been
lender involved,
sending.
and that
So
means
there's
the
that.
lender
So
should
Gianna
be
has like the
involved
school and
way
the
in
soccer,
advance
and then not
because
the.
if
It's
we're
kind of the
parking
same. She
replacement
needs to send
property, they have to underwrite the loan
Jenny some
completely
more
different
stuff, but
than if the property was being acquired directly by the
let me know if
exchange.
you're gonna make breakfast.
And we will pretty much
I'll be
sign
off in
any
20
note
minutes,
and mortgage the lender puts in
but I
front
have
of
work
us. It
to do.
just has to be non-recourse to us, although the client can guarantee. All right, so that is actually concludes the reverse exchange structure portion of the presentation. In the last 5 minutes or so that I have, I'm going to discuss these deadlines. All right, so the deadline notice came out last week. They were late in getting it out to us. Clients were sitting on the edge of their chair, wondering what to do. And here's what basically this notice provides: that anyone that's closing on, or I'm sorry, anyone that has a 45-day or 180-day deadline that falls on or after April 1st and before July 15th gets an extension of that deadline until July 15th. So if your 45 days is between April 1 and July 15th, you're extended. That 45th day is now July 15th. That means you'll have till July 15th. Days falls between that period. Your 180 days now goes till July 15th. Client opts out, and the way to opt out is you need to notify the qualified intermediary. Otherwise, it's automatic. Couple of examples. The taxpayer's relinquished property closes on April 5th. Their 45th day in the identification period is May 21st, which is now extended to July 15th. So if you by chance identified already, you would actually have the chance to revoke and re-identify in that time period. The taxpayer must close on replacement property by October 3rd. Your 180 days is not affected. It is after the last day of the disaster period, which ends on July 15th. Second example, taxpayers relinquished property closes on January 16th. The 45th day in your ID period is March 1. Hey, you don't get any extension. Not extended because the 45th day is before April 1st. The 180th day was July 14th. That is extended one day, big deal, to July 15th. So you may have the benefit of the 180, even though you lost the 45. Most of my clients really want the benefit of the 45 days being extended more than the 180, But regardless, it's a huge benefit if you fall within those timelines. Now, the notice does not address deadlines that fall before or after this exclusion period, such as identification or exchange completion periods that ended before April 1 or pending exchange periods that end after July 15th. In this respect, the notice is different from previous IRS disaster relief notice, and we have some unanswered questions. For instance, the notice does not reference Section 17 of RevPOC 2018-57, the disaster relief provision. That disaster relief provision provides an extension of 180 days or until the date specified in the notice, whichever is later. It is uncertain and not clear if Notice 2020-23, if the 120-day deadline extension provided in previous disaster relief notice applies. We don't think it does. We think that all clients should absolutely stick with the April 1st to July 15th for extension guidance, because that is based upon known IRS guidance. They may have been silent on the Section 17 intentionally because they don't want an additional 180 from whatever date is specified in the notice. They think they gave plenty of time. And if if they made a mistake and it was just oversight, then new action needs to be taken to clear this up. Some taxpayers were seeking IRS extension of dates falling after the date of the FEMA and Stafford Act. That was March 13th. And those people in that 2 week, a little bit more than 2 week, don't get the benefit of this notice, even though it may seem that that's, in fairness and rational treatment, that's the way the notice should have read. It does not read that way. Okay, so I want to emphasize that this notice applies to reverse exchange deadlines. So if your 45th day, we're parking replacement property, and your 45th day to identify relinquished property falls on or after April 1st and before July 15th, your deadline to identify is now extended to July 15th. And if your 180th day to transfer replacement property falls on or after April 1st and before July 15th, you now have until July 15th to transfer your parked property or your relinquished property, for that matter, whichever has been parked. So it gives us relief in that respect as well. Okay, this is the conclusion of my presentation. As you can see on the last page, I have all of my contact information. That 866 number goes right into my cell. So even though nobody's in their offices these days, you can reach me directly by the email or the phone number. I'm going to be emailing out this presentation. And again, please feel free to call or email if you have any questions. And again, I'm happy to present this also in-house to firms and real estate organizations, wherever the need may be. Thank you for joining, and I hope this was helpful for you.